Hello, my dear listeners. This is going to be a physical silver update. So the price action, we had the low of 2203 last night, and now it's 2370. And I still don't know why this sell-off was so deep. Okay, I was trying to find out. I can only speculate about this. I will also present opinions of Rick Rule and a link to the video that was on a Dog Watch channel, and also interview with Jim Willie. Okay, so there's two opinions, and I will present my opinion as I always do. So we have if you go and listen to Ricky Rule, he is not believing in a conspiracy. He is not very conspiratorial. He said there is no very political intention to manipulate the price of metals down. Wherever he says that if he looks the volume on the COMEX and in the silver futures, it's very high compared to the production in every day and the supply available. Okay. You also have Jim Willie with many sensational statements. Okay, he's very conspiratorial, and he's very on the other side compared to Ricky Rule. But if you see, like they agree in many terms, they agree with each other. But okay, collection of the sensational statements from Jim Willie interview. Gold is sold at ages for delivery on high orders, tons of gold. Okay, equivalent of $2,000 per ounce right now, $2,000 per ounce, and silver $35 to $40 per ounce. Okay. COMEX is still in inventory, again, Jim Willie, from SLD and JLD to make the delivery available. What we really want to understand, will the physical price decouple from the paper trading? And that is very important. In my latest video, I said that's very, if you want to get rewarded and capitalize on your investment in silver, that's what you should wish for. And the price drops like this, it's the opportunity. I've been following on the inventory. Okay, what's the inventory is going on? You was able yesterday and go on Gainesville and buy silver at $24.80 per ounce. The Buffalo rounds was available. Tolving, but you have to buy minimum 500 ounces at $1 over spot on the NTR bars. Upmex today available 100-ounce bars at $1.50 over spot. Rolled Canadian Mint. And generic rounds available on COMEX. If you buy 500, $2 over spot. If you buy over 100, $2.50 over spot. And they had some maples available as well, about $5 over spot. And American Eagles pretty much 4 weeks delay. Today, Gatesville on a generic silver, you can order it, pay $1 over spot, but it's delivery on the 5th May. On the 10th May. So about 4 weeks from now. And yeah, inventory is available. So anyone who was, patient enough or didn't buy silver before can go in and capitalize on their call. Congratulations, you make a very good call not to buy silver at $30, $35, $40. I did, okay. But I'm not regret a minute to doing that, because regardless I think anyone who said, okay, we knew this is going to happen, they didn't knew. It was no guarantee that would happen, okay. And I wish for that, because really it's a very positive event for physical stackers. Now we have, especially with this supply situation and Utah mine, it's very major. Jim Willis covered that also, the accident in the Utah mine. They produce 5 million ounces of silver that goes out to the U.S. market. They produce 500,000 a year of ounces of gold that goes to the U.S. market, and this supply is not going to be available. COMEX inventory is dropping. You have waiting for like Royal Canadian Mint and U.S. Mint of about 4 weeks now, and once the inventory, that's I think the willing dealers have, we will have the waitings about 4 weeks for pretty much anything. And in order to disconnect to happen, okay, so this situation, in my opinion, needs to occur when people who wants the silver right now, they go and to the suppliers, to the billing dealers, and they say this, they make a bid higher. They will say, okay, we will pay $1 more that you advertise price. Give us this silver. Give us the silver. Or how much you want us to pay more. Or they go on the market and say, okay, we're going to pay, okay, it's $2 over spot. We're going to pay $4 over spot, but we want the silver right now. This situation needs to happen on the market, because delays in delivery, since I'm in the market, I already see this twice. Okay, it's actually third time. In 2011, this winter in American eels, it's just one particular product. But in 2011, you know, in April, March, market was getting tight. You were waiting, and also in 2008, but you also waited. But this persists for just a couple of weeks, and if this time it just persists for like 3-4 weeks, and then inventory gets back to normal, you can see, you know, silver, I don't know, at $24, and the premiums will be back. You could buy silver at $26, and there is no waiting. So, and right now, like I said, if you want the silver, physical silver, you can buy it. You can buy it. It's truly, if you're not very picky for the product you want to get, you can buy 10-ounce bars, generic bars at rounds at $1 over spot, $25. So the physical silver came down substantially from $30 to $25 on this sell-off. This is a huge correction in 2 days, and this is very unusual considering all the events I mentioned. You know, with the supply. So we have to wait and see. And something I would say about gold, because gold is very easy to keep the cap on the price, because there is much more of it, and there is, in dollar amount, you need much more dollars to remove the inventory from the market. So retail market is not by itself not gonna make the bust on the gold prices. So while you can see actually, if the silver, in silver we can see the disconnect, but not in gold. Regardless of what Jim Willis says, if anyone can confirm or disapprove that, please do. But you know, Chinese are paying on delivery $2,000 for the gold. That's definitely good news. You know, it's the fact, the disconnect is proven. But I'm not see it here in North America. I can open and buy gold, you know, with premium at I don't know, 1400, in the low 1400s per ounce. But I'm not buying gold, and I'm not interested to buying gold for those reasons, because it's very easy to keep the cap on the price, because there is so much inventory compared to silver. Okay, the gold market is tight, it's getting tight too, but it's much more easy to keep the cap on to keep those two paper prices and paper price together in gold. So we can see, you know, the ratio starts shrinking. If we can see the situation very easily, where silver, let's say, will be at $50 level, and the gold will remain at 1500. Okay, we can see that that's very easy. But like I said, we need, you know, we need the bid be persistent there and present in the physical market. It's not gonna, the price is not gonna rise by itself. Okay, has to be the bidders who will bid higher for the physical inventory. Okay, by saying we're gonna pay that much more in premium, we're gonna pay that much more in premium, we want our silver now. Other thing I'm suspecting that may happen, that, you know, there is an institutional investor finally steps in and say, okay, this is ridiculous. I'm going to take delivery of this, you know, at $25 silver, and, you know, somebody will try to buy a few million ounces at the time. I'm surprised it didn't happen yet. Maybe it was for political reason, but I'm always expecting this, and now the situation is very appealing, you know, like, you know, to buy a COMEX contract for 5,000 ounces instead for delivery, and, you know, see what's going to happen with the premiums, and see if you will be able to get that COMEX contract delivered to you in physical form. So that's pretty much I would like to cover right now. To say that the silver it's a good buy if you can buy at $25. There's no question. It's very easy call to make. Paper price also something very important. I think about this paper price correction. I may think, because if the gold and silver would be monetized, we need to see the default in the paper of it, okay? Because it's very how to say, I see this very inconsistent, the possibility of leverage 100 times and capitalize on the move up. You know, I see this like people. I was thinking to do this myself, and I see many people are attracted to this, but this is just an illusion. It's not. In a really marketplace, there is no such a wealth that you can just go in and grab so easily. So the paper market will default, because the number of the paper ounces outstanding has to get very close with the physical ounces available to be sold, and that's what we have to see, and then we will see the real when the physical transaction will determine the price, the price that. And the price will become much more stable. Okay, the price, you know, we're not going to see the fluctuation of 20% in 2 days. You know, how any commodities can move 20% in 2 days? It's like it's just mind-boggling how you can imagine the situation. Like, imagine wheat will go 20% in 2 days, or the gasoline can go 20% in 2 days. There's something behind this move. I'm not sure what exactly it is. If you have anything more to say, please share your opinion. Thanks for watching.